Now, come 2031, sub-Saharan Africa could make billions of dollars of renewable energy investments. This is the potential of wind, solar and storage transmission projects, as highlighted by studies sponsored by Mobilist and Renewables Fund Managers. Ziad Sarang, who's Chief Investment Officer for Renewables Fund Managers, joins us with more insights around the findings of the study. Thank you so much for your time, Ziad. Good afternoon.
Yeah, thank you. Thank you for this opportunity, and good afternoon to you.
Of course, what we know for sure, Ziad, is there's a lot of potential for renewables here in the African continent, but maybe help us put that into perspective, quantifying that.
Yes, so we know that Africa has a very large energy deficit, with almost 600 million people, in fact, 579 million people, according to our study that we recently released. And that's just within sub-Saharan Africa that does not have access to electricity. That's a substantial amount of people, a huge challenge for investment and infrastructure rollout, but at the same time provides us with a massive opportunity. And this is an economic opportunity, one in building out or trying to reduce this energy deficit by deploying into, and we would like it to be into renewable energy, and thereby creating jobs and bolstering the economies of the countries or host countries for these particular investments.
What we know here, of course, Ziad, is that private investors are very much return seeking. And then, of course, African countries and African people desperately need electricity. I'm keen to find out about how we match here, the pursuit for returns and also the genuine need for development where energy is concerned.
Absolutely. I think, we've got to a point where it's no more theoretical. We can actually show that the investment in renewable energy and the return that investors get from it provides you with sustainable outcomes. And that sustainable outcome is, energy that has a low impact on the environment, because renewable energy does not need to burn any fossil fuels. But at the same time, creating energy access to the population, as well as ensuring that it is sustainable in the long term. And we've seen this in South Africa, and that's what I mean, is that you've got the ingredients to, and what do you need to actually attract investment? You need an enabling environment. And I'll give you the example of the CNI, the corporate and industrial rollout of solar power, particularly in South Africa. You need an enabling environment, and that means you need political and regulatory will, which we had by the lifting of the cap of private power in South Africa about 2 years ago by the president. What we then have is the second ingredient is financing, and South Africa is blessed with a deep financial market when it comes to investment in infrastructure, where banks and DFIs, development funding institutions, participate very keenly. The third thing you need is a technical competence, which South Africa obviously had previously, and used that technical competence to roll out those investments. And the end result was in the span of 2 years, you've had more than 5,000 megawatts of renewable energy, particularly solar, that's been rolled out in South Africa. So, those are at returns that investors generally seek to achieve, and the money will flow. So you've got the best of both worlds, almost a win-win. Returns for investors, new power on the grid, gives Eskom a break. The economy takes an uplift, and that's the cycle we want to see repeated, not just in South Africa, but across the continent.
What we also have seen here, Ziad, of course, is just capital becoming a little bit more pricey. I'm wondering if that might also change the risk appetite for many investors, creating even a bigger need for the environment to be enabling, for the risk to be shared between government and investors. How has this high interest rate environment affected investment?
Absolutely. Interest rates have an impact, obviously, because the weighted cost of capital increases. However, these are long-term investments. So, you need to look through the cycle. It's not a 1-year investment decision. We invest in very large projects that have got 20-year PPAs or power purchase agreements. So you need to take a long-term decision and look through the cycle. Yes, we are at all-time highs when it comes to interest rates, but that should not stop us from investing in projects that have got a long-term benefit, and you're taking a very long-term view.
What we also know, of course, is that Kenya, Nigeria, and South Africa, largest markets there. Let's talk about that, but also where we might be seeing the emergence of other key markets as yet.
Yes, I think, South Africa certainly has the largest opportunity set because it had started its renewable energy investment program a long time ago, around 2010, 2011. However, Kenya and Nigeria are obviously the two largest markets, mainly within the C&I space, the commercial and industrial space. And that is because demand from industrial users are quite significant. And obviously investment will go where there's demand. And from that perspective, we see Kenya providing quite a large opportunity up to 2031. Around 60% of C&I is likely to come from Kenya. However, the projects are a lot smaller with respect to the projects that you get in South Africa, and I think that is the issue. You need scale for these projects, and when you have a programmatic approach, and I come back to the example in South Africa, where you have a large amount of demand and you have very large projects, capital generally flows towards those projects much easier. And as Kenya and Nigeria pick up in terms of larger projects, I think you'll see bigger flows going into those markets. You have obviously countries like Mozambique and Botswana that are looking at renewable energy projects, but it's all demand driven. If you've got large industry, you tend to have larger investors coming in to provide larger power plants.
And before I let you go here, also keen just to touch on the role then of innovative finance solutions, to also be a catalyst for what we're aiming to see here.
Yes, absolutely. And that's what Revigo is. The fund we manage is something that is not your typical private equity fund. What we are trying to do is deepen the secondary market. And what do we mean by developing the secondary market? All of the focus in investment within the renewable energy and infrastructure, for that matter, on the continent has been for primary investments. But that is only one half of the equation, we believe. In order to catalyze investment in a financing ecosystem that releases capital from those primary investments through to recycling that into secondary investments and ultimately in the hands of large institutions. That is effectively what we're talking about, the innovative financing, where we ultimately recycle capital from primary into secondary and then onto public markets, listed equity markets, where you've got institutional investors that can recycle the capital out of developers, where they would put their money back into development, and that cycle will continue. And that is, we've seen this before in the developed markets. Africa or sub-Saharan Africa is literally where the EU and the US has been in 2012. So that market does have a recycling of capital, and we need to have more focus, particularly from DFIs and institutional funders, to not ignore the secondary market, to be part of the secondary market, to have a healthy ecosystem.
Indeed, a very good opportunity awaits there, Ziad. Thank you so much for talking us through this one this afternoon. That was Ziad Sarang, CIO of Revigo Fund Managers.